Bill Gates is widely considered one of the greatest entrepreneurs of all time. As the co-founder of Microsoft, he helped lead the personal computer and software revolution. This generated a massive fortune, making him the richest man in the world for many years. So how does Gates invest his money? Well, we've all seen the headlines about him owning massive amounts of farmland, along with his investments in biotech and clean energy startups. However, these are only a small portion of his wealth and not accessible to the average person. Through the Bill and Melinda Gates Foundation Trust, Gates invests a large portion of his wealth in public common stocks. Today, I'm going to analyze the top 6 stocks that Bill Gates owns. My name is Zach, and you should leave a like and subscribe to the channel if you enjoy the video. In the analysis of each stock, I will be using my personal stock research tool that I developed. If you like what you see, the tool is available along with many other features at dividenddata.com. In the year 2000, Bill Gates and his wife created the Bill and Melinda Gates Foundation. This is their philanthropic vehicle and Gates' main focus in life after Microsoft. Through his friendship with Warren Buffett, Gates learned far more about the world of investing. This influenced him to diversify his wealth outside of Microsoft, especially after the dot-com bubble. Over the following decades, Gates would sell more and more of his Microsoft stock to fund the foundation. Buffett also decided that he will donate his massive fortune to the Gates Foundation, gradually giving away Berkshire Hathaway stock. This has provided massive funding from 2 of the world's richest. That foundation currently spends over $6 billion a year. This is expected to increase to around $9 billion annually by 2026. Both Gates and Buffett regularly donate new capital. However, the economic future of the foundation is reliant on the performance of the trust. So the investments that Gates makes have a strong emphasis on retaining capital and seeing reliable growth. So what does the foundation's trust look like today? As of the latest reported data from November 14th, 2022, the trust had $33.99 billion in assets under management. This is spread across 21 total holdings. The top holding is Microsoft, ticker symbol MSFT. This represents 26.91% of the portfolio at a total value of $9.14 billion. The interesting thing here is that virtually the entirety of this position was just added in the latest quarter. I recently made an entire video about that very stock purchase. Gates bought over 38.3 million shares at an average price of $247.12. This is a giant change to the portfolio. So why did he buy Microsoft? Well, if we look at my dividenddata.com stock research tool, you can see the fantastic financial metrics the company has. Microsoft is a high earnings growth company with reliable subscription revenue and a stellar balance sheet. It is truly the definition of a blue chip stock. Over the past 5 years, revenue per share has grown at a 17.9% compound annual growth rate. Net income per share has grown at a 28% compound annual growth rate. Free cash flow per share has grown at a 16.49% CAGR. Margins are fantastic as software is highly scalable. Annual gross margins sit at 68% and net margins are at 36%. Their balance sheet is among the best in the market. They have shareholder equity of $183 billion and negative $40 billion in net debt. Microsoft has a massive $100 billion in cash on hand. This, combined with their reliable and growing earning power, allows Microsoft to act from a position of strength. They can afford to make acquisitions and long-term investments during a time of economic weakness. This can be seen by their all-cash offer to acquire Activision Blizzard. Most recently, they announced a multi-billion-dollar investment into OpenAI, the creator of viral products like ChatGPT. In addition to this, Microsoft rewards its shareholders with a reliable growing dividend and share repurchases. The 5-year compound annual growth rate of the dividend is 10.11%. The most recent dividend increase was 9.68%. The payout ratio sits under 30%. Based on this, Microsoft is certainly financially strong. At the current price, the stock is trading at a 25.9 PE ratio and a 1.13% dividend yield. That's not outrageous considering the growth Microsoft has been seeing. However, the company did just report Q2 earnings and some investors are worried about slowing growth. Year-over-year Q2 revenue is only up 2%. Their largest 2 segments, productivity and business processes and the intelligent cloud, are both up 7% and 18% respectively. Within the cloud, Azure saw revenue growth of 31%, performance, slightly beating expectations. That said, PC sales and gaming were down massively. This is sector-wide, with PC sales seeing the largest percentage drop in history. This was likely due to the current recessionary environment and the massive work-from-home demand in 2020 and 2021. These are incredibly hard comparables to match. Personal computing revenue decreased 19%, with Windows OEM and service devices revenue dropping 39%. Xbox revenue was down 12%. Luckily, this personal computing segment is less than 27% of overall revenue and a lower margin part of the business. As a Microsoft stock investor, I find it impressive that they still saw overall growth despite the very weak PC market. I'd expect 2023 remains a slow growth year for the company. However, as the overall economy improves along with the PC market, I'd expect Microsoft overall growth to accelerate back to these higher levels. If true, then I see Microsoft as a wonderful company trading at a fair price. Now, this is his largest holding and a stock I follow quite closely. I won't go as in-depth on many of his other holdings. If you want to see a full stock review on Microsoft, I recently made a video linked here. Stock number 2 is Berkshire Hathaway, ticker symbol BRKB. This represents 23.32% of the portfolio at a total value of $7.93 billion. The position was decreased over 14% in the latest quarter to help fund the Microsoft purchase. The average buy price is $145, up 84% at current prices. This has been a long-term holding. If you don't know Berkshire Hathaway, this is the company run by Warren Buffett. He's widely considered to be one of, if not the greatest investor of all time. Since 1965, the compounded annual gain of Berkshire Hathaway sits at 20.1% compared to the 10.5% of the S&P 500. Over that long time scale, this makes the overall gain 3.6 million% compared to the 30,000% of the S&P 500. That is a wild difference. As I mentioned earlier, Buffett is donating all of his wealth to the Gates Foundation, so it's pretty easy to understand why the trust has a massive holding in Berkshire Hathaway. It is, without question, one of the best-run companies in the world. The financials are stellar. $902 billion of total assets, shareholder equity of $455 billion, $108 billion of cash on hand, and only $7 billion net debt. They are in the business of owning businesses. Berkshire has a large number of fully owned private companies in addition to their large public stock portfolio. Fully owned companies include the BNSF Railroad, Geico, Berkshire Hathaway Energy, Nebraska Furniture Mart, See's Candy, etc. In their public stock portfolio, they own large stakes in Apple, Bank of America, Chevron, Coca-Cola, American Express, etc. Berkshire Hathaway collects the profits and dividends earned from these investments and reinvests that money to increase their future earning power. It is set up as a money compounding machine. Comment below if you want to see a full video going over all of Warren Buffett's public stocks. I really could go on forever here. Stock number 3 is the Canadian National Railway Company, ticker symbol CNI. This makes up 17.42% of the portfolio, currently valued at $5.92 billion. The trust position has increased 433% in the latest quarter. The average buy price per share is $93.34. This is up 32.9%. CNI is an industrial stock engaged in rail and related transportation business. It operates a network of 19,500 route miles of track spanning Canada and the United States. Railroad companies are notorious for having wide economic moats as they are regulated and vital to the transportation of goods. On top of that, they have strong financial growth, which may surprise some investors. Over the past 10 years, revenue per share has grown at a 7.36% compound annual growth rate. Free cash flow per share has grown at a 14.37% compound annual growth rate. Margins are surprisingly high at 41% gross margins and 33% net margins. One possible negative would be their cash position relative to debt. As of the latest quarter, CNI has $400 million in cash on hand and $15 billion in net debt. However, this is not that bad as they generate just under $7 billion a year in operating cash flow and $4 billion in free cash flow. The company returns a large amount of capital to shareholders through a growing dividend and share buybacks. Here you can see the massive decrease in shares outstanding since 2002. This increases your relative ownership stake in the company. The dividend, although not consistent, has grown at a huge 14.54% 10-year CAGR. The dividend payout ratio is around 40%. This is sustainable and will be able to continue growth, but the dividend has been rising faster than earning power. At current prices, CNI stock trades at a 22.4 PE ratio and a 1.82% dividend yield. At first look, that seems a little on the pricey side, but not if they can continue their track record of growth. It certainly appears to be a high-quality, reliable business. Based on current prices, I personally think that Microsoft stock is a better deal though. Stock number 4 is Waste Management, ticker symbol WM. This makes up 16.61% of the current trust, valued at $5.64 billion. This position was increased 89% in the recent quarter. Overall, the buy price per share is $95.11, up 60.1%. The latest batch of shares was bought at $156.60. This industrial stock is the dominant waste management company in the United States, hence the name. It offers collection services, including picking up and transporting waste and recyclable materials for residential, commercial, industrial, and municipal customers in North America. Humans are very good at making trash, especially in developed countries like the US. I expect long-term demand will only continue to increase for waste management. If we look at the financials, you can see that revenue per share is growing at a 6.68% 5-year compound annual growth rate. Free cash flow per share is growing at a 9.5% CAGR. Annual margins sit around a 38% gross margin and 10% net margin. The balance sheet is a weaker aspect with $137 million in cash on hand and $13.9 billion in net debt. Now they do have reliable growing earnings with $4.3 billion in annual operating cash flow and $2.4 billion in free cash flow. This debt will likely not cause an issue anytime soon. Waste Management rewards shareholders with a growing dividend and share repurchases. Since 2001, the company bought back shares consistently. The 10-year compound annual growth rate of the dividend sits at 7.87%. The most recent dividend increase was 13%. The payout ratio is around 50%, which is sustainable. At current prices, Waste Management stock is trading at a 28.46 PE ratio and a 1.7% dividend yield. I would definitely say it's getting a market premium in this current economic environment. In my opinion, this is not a strong buy relative to other options in the market. That said, the company is extremely reliable with a dominant position in a vital industry. Stock number 5 is Deere Co, ticker symbol DE. This is 3.85% of the current portfolio value at $1.31 billion. This position just increased 335% in the latest quarter. The purchase price per share in the latest batch was $316.68. DE is an industrial stock with the iconic John Deere brand. In the US, Deere commands 53% of the tractor market and 60% of the combine market. The company is dominant with surprisingly fast earnings growth in recent years. The stock price has followed suit with that massive growth. Revenue per share is growing at a 12.63% 5-year compound annual growth rate. Net income per share is growing at a 27% 5-year CAGR. Free cash flow is less reliable with a down year in fiscal 2022 and massive years in both 2020 and 2021. Free cash flow has even been negative for multiple years at a time. Overall, 2022 definitely appeared to be a decline in both operating and free cash flow from the massive growth of 2020 and 2021. I'm not sure the exact cause here as I haven't followed the company that closely. Deere has $5.5 billion in cash on hand and $46 billion net debt. DE stock returns massive capital to shareholders. They have had a large stock buyback program over the past few decades. The dividend has increased massively in recent years. Over the past 5 years, they have increased the dividend at a 13.7% 5-year compound annual growth rate. Deere had 4 big dividend increases in the span of 2 years at 18.4%, 16.6%, 7.6%, and 6.1%. The question here is whether that growth is sustainable. Based on net income, the payout ratio is a measly 18.41%, so very good by that metric. However, with last year's free cash flow, the payout ratio would be well over 150%. Personally, I would have to do more research about why this happened and what it means for the future earning power of Deere. It very well could have been a fluke and they rebound and put up great financials in the years to come. However, I would expect slower dividend growth if free cash flow remains low. At current prices, Deere is trading at a 17.77 PE ratio and a 1.16% dividend yield. If the recent earnings growth is sustainable, then Deere stock will be a great investment at these prices. However, if it sees a slowdown or decline, then the stock may generate low returns at these levels. Stock number 6 is Caterpillar, ticker symbol CAT. This is 3.55% of the current trust, valued at $1.21 billion. This seems to have been a longer-term holding that was slightly pared down in 2022 Q1. Caterpillar is an industrial giant that manufactures and sells construction and mining equipment, diesel and natural gas engines, and industrial gas turbines. The business is quite cyclical to infrastructure cycles. Right now, the business is doing great and will likely continue to as they benefit from the large U.S. infrastructure bill. However, there is a question of how much this is priced into the stock and whether earnings will keep on growing. When we dive into their financials, you can see just how cyclical their business is. Over the past 10 years, the revenue per share has grown at a 0% compound annual growth rate. That is because of its cycles. However, over a long time scale, there has been significant growth. Net income has grown at a 4.56% 10-year compound annual growth rate. Free cash flow per share is growing at a 6.15% 10-year CAGR. The balance sheet is stable with $6.3 billion in cash on hand and $38.1 billion in net debt. With operating cash flow of $7.19 billion and free cash flow of $4.7 billion, the company is very comfortable financially. However, with growing dividends and share repurchases, they may need to use the balance sheet to support their dividend in a down cycle. Caterpillar has been growing its dividend at a high rate. The 10-year compound annual growth rate of the dividend is 8.8%. The current payout ratio is around 40%. At current prices, CAT stock is trading at an 18.8 PE ratio and a 1.86% dividend yield. If they see large growth over the next few years, then this could be a good value. However, the stock is destined to fall if earnings decline. Personally, I like to buy cyclical companies like this when they are deeply out of favor. Not right now when it's doing well and expectations are high. This is similar to my approach investing in oil, which some of my viewers may be familiar with. Gates has not been buying the stock in recent years, but is riding the wave of positive financial performance. These 6 stocks I discussed today make up just under 92% of the portfolio. His top 2 holdings, Microsoft and Berkshire Hathaway, make up 50% of the trust value. The other top holdings follow a trend of being dominant positioned industrial companies. All of the stocks are financially strong and tend to get a premium valuation for being perceived as safe or reliable. I hope you found this deep dive into Bill Gates' portfolio interesting. Comment below if you want me to do a similar video on any other famous investors. Thank you for watching Dividend Data. You can sign up for dividenddata.com to use my stock research software and join a Discord community of like-minded investors. Follow me on Twitter for all my latest stock buys and dividends coming in. Thanks for watching.